the first segment was on buying correctly and where to set your stop. And your stop doesn't always have to be at 8%. If the stock is setting up nice with a nice tight base, lots of times if that base is broken to the downside, then you have a sell point that is less than 8%. So buying right solves a lot of problems and also keeps your losses smaller. If you're buying extended stocks, then your sell point is usually farther away and you probably have a farther downside. So much of making money in the market is controlling the risk and controlling that risk when you're wrong. Because if I've always said that in a year, if you have one or two really nice winners, the stocks that double in price, and you treat them well, I mean, you have a decent position in those one or two stocks. If you have a lot of small losses, those do not equal the big gains that you might have in those big winners. So I always tend to have, two or three or maybe even more big winning stocks, and then a lot of very small losses. So always control risk. So on this, that was the first segment. The second segment was selling into strength, and that's when a stock gets extended or gets too far away from its moving average to the upside, or breaks trend lines to the upside, or as we looked at for a few minutes, stochastics. When the stochastics get up above 80, that sometimes tells you, okay, the momentum has been good here for the last few days or weeks, and maybe it's now time to sell some into strength. The last segment is selling into weakness. And this is selling into weakness is really selling when a stock starts breaking down, starts rolling over. And so you can get, if you wait for weakness, lots of times you can get larger moves. And it's the three tools that you use, and these are very similar to the other selling segments, is that you look for moving averages, you look for trend lines, and you look for price and volume and what's happening there. And throughout your holding of a stock, you're always looking for change. Is it acting differently than it's acted in the last, since you bought the stock? As conditions changed, is the volume changing? Is it picking up to the downside? Is it breaking moving averages? If you draw trend lines, are those being broken? So a lot of things to be looking for. So the first example I want to take a look at is PKI, and this is Perkin-Elmer. And this is a current. This I still hold, and it's been a good stock. But I think there's a few things that we can take away from Perkin-Elmer. And if we look at you're looking at a weekly, and you can see what a nice move it's made. But let's go to the daily. And if we look at the if you look at PKI, and you go to the move that it made from April 2020 to February 21st, 2021. Mm-hmm. And you'll see that in April so it came down during COVID, the lockdown, but then in April it popped up. I guess at the end of April there, it popped up above 136, kind of a lower.
I'm sorry, I was distracted, David. Should I?
Just go to the regular chart. Just go to don't change the time frame. Yeah, don't change the time frame.
Okay.
Get to today. You can get it all. So you can see, and at the end of April, the stock popped above 136, and that's kind of a very low buy point. But you can see that from that point on, the stock was living above the red line, which is the 50-day moving average. Yeah, you can see that. And really the best buy point on this was that, here's really the proper buy point, 157.53, where the stock came up and it went sideways. And you see how tight it was? Really nice, tight, going up, go farther, go to 157 there. Yes. See how nice and tight that was, just going sideways, and that's your buy point as it's going through there. So then what you can use on it when a stock is breaking out, and it breaks out quickly and it makes a lot of progress, lots of times it moves along the 50-day, sorry, the 21-day moving average, and that's the green moving average line below the stock. You see how it comes down to it, kind of gets support on it, and then it starts moving back up. So then the stock, let's see. So now we've got one. So now, okay, so now it's building a new base, and the stock is just going sideways and staying above the 21-day. As the stock moves along, let's see what I want to go. Yeah, I'm sorry, and if sorry, David, if you could go to,
Sure.
yeah, if you could go back to that, go back to February of 2021.
Oh, sure. Yeah. Let's go back in time
Because
and
we'll
we'll
get
change
that
this.
move before COVID, and
Yeah.
then
How's that?
yes,
I
okay,
can
so
go back
that's
further.
good. Okay, so the
Yeah.
stock really came out, I guess, at 105, broke out at 105.70 at a nice little base there. And then see, this is a stock that at first it was above the 21-day moving average, the green line, got up to 123.21 and started going sideways. And then as a stock goes sideways, there's no reason to sell a stock just because it goes through the moving average if it's moving sideways, because eventually any moving average is going to come up to the stock if it goes sideways long enough. And the red line, which is the 50-day moving average, you can see how many times this stock gets support on that 50-day moving average. It got it at right around 111.45. It got it again, yes, at 119.94. It got it again. It broke hard. And I don't know exactly what that was on, at 128.02. And then just stayed above that all the way until then 137, it broke it, and it broke it on some huge volume. But you can also see signs of maybe the stock starting to get a little bit weaker when it hit that 162.70 right there. The stock had a pretty quick run up. And if you could draw trend lines, this is where you draw some trend lines from 142.65 over to 149.95 and go across. You see, sometimes when stocks, they get ahead of themselves, that usually when they're having such a good time on the upside that they pay for it on the downside soon after. And that's what happened. You can see how the volume picked up, and you got 5 days in a row on the downside, with 3 of those 5 days were very strong volume, or was volume over average daily volume. And then it came down again, it rallied again, but then you got hit again on that 2.7 million share day, and it went below the 50-day moving average. It tried to get back up again, and you can see it took 1, 2, 3, 4, 5, 6, 7 days to recover what it lost in one day. Never a good sign. It didn't come back quickly, and then it broke the 50-day for the third time, and then it really started living below that. So what is starting to happen is that it's starting to break quickly and then have a hard time rallying. That's the change that you always want to see, or that you start seeing when a stock is topping. It breaks hard, and then it takes days to recover what it broke in 1 or 2 days. So that's the change that occurred. And then we already went through, if you go back to today.
Well, before we do that, David,
Yeah.
I'm just curious to ask you whether, I know that earlier in earlier shows you talked about shorting certain stocks when the market was weak, and certainly in the first part of February to March, tech stocks and non-commodity stocks, they really were getting hit on the chin. So do you think that looking back, I don't know if you had actually considered this a short sale, but it has this look of a very compressed head and shoulders here Any thoughts on that?
Yeah, Bill has always said that a Head and Shoulders, the right shoulder should be lower than the left shoulder. And if you're
Mm,
looking at 149, it's the left shoulder, and
mm,
160, 156, the right shoulder's higher. It's also been such a good, strong stock, very consistent stock with great earnings. This wouldn't be one that I would be shorting. And also, tops usually take 3 months, and I guess that's maybe about 3 months, but something that has been that is that good and consistent, I would look for something a little lower quality. But it's, yeah, some of your best shorts come from stocks that have huge moves.
mhm.
So a possibility, but something this good, I would probably stay away from it on the short side.
Okay,
But if you go to the back to
let's go
where
to
we
the
are
today's.
today, yeah,
Yeah.
it's just back to see. So now this stock came out of a great base at 157.53, broke out, and is sitting above the 21-day moving average. And that's what happens on a strong stock. It gets up, it runs out, and this is what you like to see. The volume, it had 2 days, one day, really, I guess 2 days of bad volume after it hit 188.40. And now it's going quiet. It looks like it tried to break out yesterday. Now it's off today, but that's fine. The stock is acting nicely. So that's using some of the moving averages. If you go to, let's go to Generac, which is a great example because it's had some great moves. And here's another one where if you bring the cursor all the way to back in, I guess, December of last year, you can see the stock coming out at 234, above that 234.55 area, breaking out, and then runs up quickly, actually pulls back to the 21-day moving average after the initial, didn't do it on much volume at all, and then has a great run all the way to 346, and it's moving above that 21-day moving average. And then once it breaks it, it just starts going sideways for a while, and then the moving averages are going in and out of it, which is fine. If the stock's just going sideways, moving averages catching up to it again is fine.
Mhm.
Breaks out again in that at 340 area. Yeah, and yeah, 342, 340, that's right there. And so now it used the 21-day moving average. If you're going, the longer the moving average you use, the longer the move you're going to get, but then you also have to give up some of the gain for a while. And you can see if you use the 21-day, you could have gotten out, I guess, when it broke it on that big down day that came back when it dropped all the way to 382. Breaking that, you could sell some of it. See that, and that's what's I on all these strategies, I just don't use, I sort of combine trying to sell some of it on the way up when it's in very, very strong. So then when it does start coming off, I don't have as big of a position and to go through a correction. So now the stock went sideways, hit 383 a couple of times, and now is pulled off of it. Looks like it's building a new base. And if it goes out of that 457 area, that would be another buy. One other to look at, Apple. Look at Apple Computer,
Sure.
the recent chart. Now, this is one, a lot of people, they never want to sell Apple because it's been such a great stock and they've had it so long. But here's one that really didn't do a whole lot for from, it looks like, September of 2000 up until just recently. But you can see this got support on the 200-day moving average, which is that black line that came in at 122 and 123. Now, if it starts living below that, then I would say, okay, things have really changed. But you can use longer term moving averages to keep you in a stock. And if you go to a weekly on this, you'll see that there have been other times where, look at that black line, look at that 200-day moving average line, how that has supported this stock all the way since it broke out back in December quarter of 19.
Mm-hmm. Mm-hmm.
You could maybe point to that.
Yeah.
that
Right
spot,
around here.
right? Yeah, right when it came out there.
Right there.
See,
Yeah.
yeah, during COVID, it came down right down to that 200-day moving average, went through it, but then quickly regained it, and then got support two more times at 120 and 130, and still continues up there. So what moving average line you use depends on your time frame. If you're a much longer term investor, then if you get a great stock, you can use that 200-day. If you're a little bit shorter term, you can use the 50-day. If you're very short term, you can just use the 21-day exponential moving average, or you can use a combination of both of strategies of using the 21-day, or when it gets extended, selling into strength, and then holding a longer term position, waiting for a new base, and then buying it again. So a number of different ways. The other thing that's really kind of interesting is if you go, I'm sorry to go back and forth, but if you can go back to
Not a problem.
PKI.
Let's do it. Absolutely. And a weekly, daily?
You can go weekly
Okay.
on PKI. If you look at the move that the stock has had since it broke out at, well, you can do this twice, at 100 back, yeah, right there. One thing I've also found is that as it takes a while for an institution to take a position, and I've talked about 15 days and 12 out of 15 days up, that's 3 weeks. That's a 3-week period of time. It takes institutions that are buying millions of shares, not one day, not 2 days, but they do it over a number of weeks.
Mm-hmm.
Well, as it takes them a while to come out of a stock, into a stock, it takes them a while to come out of a stock. And when you see more than if you see 3 weeks in a row on the downside, that's telling you an institution is probably coming out of the stock. Now, if you look at the move that Perkin-Elmer made from that 100 area all the way up to 160, it never got 3 weeks in a row. And there might have been one spot I see in maybe the middle of the December quarter where it got 3 weeks in a row, but those were very, very small. You had one bad week down, and then the next 2 weeks it just drifted aside. That's not selling. That's, it had one bad week, and then the next 2 weeks were inside the other 2 weeks. To me, that's not big selling. But if you see something where you get 3 weeks in a row, where it actually did happen in, that would be at the, I guess, that would be, I got to get mine going here. At March 5th of this year.
March 5th, right.
Yeah, that was 3 bad weeks in a row where it did it on volume. And when that happens, usually the stock, if it's a great stock, has to base out longer. But you're looking for, I have found that if you look at some of these moves and some great stocks, you'll see that they can go for 18 months without 3 bad weeks in a row. It's just a very simple tool to say, okay, I think this stock is in the right spot. It's got great earnings. It's in the right group. I'm going to let this thing go before, I'm not going to sell it before it has really 3 bad weeks. And sometimes you can get some huge, terrific moves out of some stocks. And if you look at Perkin-Elmer right now, since its last, well, even from the bottom in March of this year, the stock has only had really 1 week down. And then the next week is either inside or it's back up. Mm-hmm. Just showing you great strength and a stock that you might want to hold for a longer period of time. So using moving averages, depending on your time frame, using price and volume, looking at the number of weeks in a row, or even looking at the number of days in a row, can give you some great indication of when it's time to sell the stock.
So 2 quick follow-up questions in this great educational module here, David. One is one thing that Bill O'Neill often said in the last few master's program workshops in Santa Monica was that he said that even though you see a great stock fall below the 10-week moving average and maybe a couple points below that 10-week moving average line, it wasn't necessarily a sell signal, and because he wasn't seeing heavy volume. I'm just pointing to one example here, June 26, 2020. You see that it was down sharply for the week, down 4.5%.
Right.
Volume picked up from the prior week. It did finish about 1.1% below the 10-week line, and yet that would turn out to be the bottom of the base. In your time working closely with William O'Neill, founder of IBD, uh, do you recall those kind of conversations?
Yeah, well, I've seen that myself, and see sometimes stocks come down, and maybe traders know that people are going to sell right when it goes through that 50-day, but you have to consider too that was when the stock was just starting to come back up, and the actually 50-day moving average, if I'm in the right spot, the well, that's yeah.
We can go back to that
No, it's okay.
June. Yeah, it's not a problem.
Oh,
Let's see.
so that was in April. That was in April of this year.
Oh, April of
Yeah,
this year? Sure. Let's look at it right over here. This
yeah,
was April, May
yeah.
4th. Yeah,
And see if I mean, I don't think even at this spot you would have already been in the stock, but
right.
that was a 50-day that was still coming down and it broke it. But you'll see that same thing when the stock's in an uptrend. Lots of times they do come down and they break the 50-day for a day or 2 days. And if it's not on heavy volume and it doesn't look like huge selling, then yes, you can give it a little bit more room, because if it's a great stock, then it'll come back very quickly from that break of the 50-day. So sometimes you can give it a little leeway. It also depends on how steep the correction is, what the volume was, and how big the move has been prior to it breaking that 50-day moving average.
Very good. And the final question would be looking at, let's set it to today, and the fact that, well, 2021, really nice earnings growth expected, 20% growth, but 2022, we're already seeing quite a negative drop here.
Right.
How does that fit into your calculus?
Well, okay, so earnings are great now. Those are estimates, and you should, on estimates, you have to be a little bit careful. I would also say if those estimates are really going to be accurate, why is the stock up at highs?
Hmm.
Is if in next year it's really going to fall off. So this is where I put a lot more weight in how the stock is acting technically, and not as much weight in the estimates, because those are just estimates. They're not fact. What's the fact? The fact right now is saying this stock is strong, the stock is doing well, and as long as it continues to have a great supply demand characteristics, then I'm
Hmm.
going to go ahead and stay with those stocks.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.